That being said, let's get started. And so today I'm going to talk about options and income options. And just first off, I'd like to say that the following webinar is purely educational. Any stocks, futures, options mentioned does not constitute advice and should not be construed as recommendations. I appreciate your opening for me, and yeah, I've been actively trading for over 30 years. I was previously executive vice president for one of the largest oil trading companies in the world and ran their international trading desks for over 10 years out of the lovely, beautiful island of Bermuda. And we were, one of the largest trading companies, period, as far as oil goes. And we went on to expand our trading into all the different derivatives, S&Ps, DAX, all the different futures markets, and eventually foreign exchange. Been blessed and able to be involved in all different types of trading aspects. I love trading. It's just a fascinating industry, period, and just it's also the thing I love about trading is the expansion for your mind and just you're continuously learning. I always tell my clients and members that there's no perfect trader, there's no perfect system. Trading is just kind of a journey. So I continuously learn something each and every day, and hopefully I can pass on some things to you today that you can use on Monday. We went on to, I first got started in options, actually trading crude oil back in the mid-'80s, and we traded a lot of over-the-counter options on crude oil. Went on to launch the over-the-counter institutional options brokerage desk for the largest privately owned brokerage company in the world, PVM Oil, and did that. That was an extremely interesting experience too, because it really got you involved in some very huge different types of option structures. So all in all, it's been an interesting career, and hopefully I can pass on some of my experiences and knowledge to you all today. So I always kind of like to start out, though, to get a feel for everybody that's here, is I like to see how many of you, and you can just put a yes or no in the box, but I'd like to get an idea of how many of you would like to be more active in the markets trading, maybe as a full-time job, but you don't feel you're quite ready there, as far as maybe knowing the experience of it, or maybe it's a confidence issue. So, but I'd just like to get a feel if you just put a yes or no, see what kind of group we have here today. Lots of yeses, and that's a good thing. Well, I still vividly remember when I went out on my own trading full time, and I tell you, it was a very nervous start for my trading when it was my own money, because it was a totally different feeling. When it was my hard-earned dollar, I did not have any type of insurance policy to bail me out if I failed. No rich parents to bail me out. So it was a different experience, and I understand that when it is your money on the line, it's sometimes hard to pull the trigger. Also I look back when I was running the international trading desk, I also found myself in plenty of very nerve-wracking trading situations. But at the end of the day, it didn't really affect me personally because it was not my money at risk. It was the owner of the company. And as long as I followed his, trading protocols and rules we had in place, he was okay with trading losses. That was just part of the business. And believe me, we had some really ugly losses at time. And it's never fun to lose. But you know what? It wasn't my money. It wasn't my savings. It was the guy I was running the desk for. And again, he was an extremely wealthy individual. So it was really a different type of uncomfortable feeling when I took a loss from my own capital account and not his. Now, the other thing too that was different when I first started out trading was my trading style. When I was, running a large trading desk, our trading style was, very aggressive with a lot of capital at our disposal. So we were kind of big momentum traders. We were able to push the markets and use this to our trading advantage. So when I began trading my own account, I found myself trading too much like I still was trading money for a big hedge fund, which I wasn't. So my trading drawdowns were way too stressful and painful. So I had to totally change my trading style if I wanted to stay in business and be successful. So now my trading for my own account really improved once I learned how to better control my risk. And the huge breakthrough was really learning how and then also committing to limiting my downside in any trade taken. And I did this, and I do this currently by using option spreads. And then the really big aha trading moment for me came when I started taking advantage of option premium collection type strategies in my own trading. Now, once I committed to this, then it became a totally different game for me, and I could finally, sleep a lot better at night. And I really believe that probably 60 to 80% of a trader's success comes from how you emotionally handle the markets. It can really come down to keeping in check those time emotions that surface from fear of the markets going down or missing a trade, and then greed. But when you know the maximum loss you can incur based on your trade setup and you're okay with it, then these fears are kind of relieved, or greatly relieved actually. And the really cool thing too is that option strategies allow you to completely control your risk by using spread setups. You decide how much you're going to put at risk, and then you structure the trade accordingly. And it's that simple. So, I'm excited about option income strategies, and I'll be discussing this with you guys today as we move forward. So let me get started and try to hold your questions to the end, and hopefully I'll have enough time to answer them all. Now, ask yourself this. What if you could add a new stream of income now? Would it change your life? And if the answer is yes, then do you have a plan to achieve that goal? So what we're going to talk about here today is a 5-step option plan I put together. Step 1 is how to embrace risk for trading opportunities. Step 2 is avoiding the #1 option trading mistake. 3, most important option factor. 4, how option pricing works. And 5, highest probability option strategies for every market. So first off, though, how do you embrace risk for your trading? Now, trading, is all about managing uncertainty. The fear of uncertainty can kill your account, but if you shift your approach to choosing to manage risk instead of uncertainty, you will create an account winner. And, how is this done? First off, you need to, have a simple, you can have a simple trading plan. It doesn't have to be too extensive, but, choose your risk limits. And then you want to own accountability for your trading decisions. It's your decision, not the broker. You put the trade together, understand it, so you be accountable for it. Understand the risk with the strategies you choose. Know how to defend any trades you enter within the chosen risk parameters. Before you enter a trade, understand the trade and know what your different scenarios are in case something goes bad. Choose the trades that have defined risks that meet your guidelines. So remember, you're in charge. So I always tell my clients, embrace risk. If you understand the risk involved, then it offers you opportunity. So embrace it. Don't look at it and fear it. Step 2 is avoiding the #1 option trading mistake. Option trading has many more advantages than trading stocks, but it can be a bit more complicated. And for the new option trader, or somebody just starting out, it can be a little intimidating as well. Now that's why so many investors decide to begin trading options by just buying short-term type calls or maybe puts, especially out-of-the-money calls, where the strike price is above the actual stock price. Since a lot of the old investors that are just starting options are familiar with the old pattern: buy low, sell high. That's kind of been ingrained in our minds for 10, 20, 30 years from all the different brokerage commercials that are out there. Buy low, sell high. But the option trading mistake that many make, I'll go through an example of this, is imagine you're bullish on the stock Facebook and it's trading at $65 a share. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration that have a strike price of $80 because they're cheap. You can get them for 15 cents or $15 per option contract. And why would you do this? Because you can get a lot of them. So let's do the math. And remember that one option contract is equal to controlling 100 shares of stock. So let's say you purchase 100 shares of Facebook at $65. That would cost you, $6,500. But then you think, okay, well, I can take the same $6,500 and I could buy 433 contracts of the $80 calls, and that would control over 43,000 shares. And you're thinking, oh my gosh, that's unbelievable. So then think, okay, well then what if Facebook, goes up and hits $81 within 30 days? And the 80 calls that I bought for $15 are now worth $105 per option contract just prior to expiration. Then you're doing the math in your head and you say, well, that's over $38,000 in a month. So I mean, that's great profit, So you're thinking, okay, I just found, I found Eureka. I found the golden egg, So at first glance, this kind of leverage is very awesome, and I do agree. So if you could do these type of returns and profits each month, that would be awesome. But don't get fooled by the glitter. It'll fool you every time. Now, one problem with short-term out-of-the-money calls is that you not only have to be right about direction the stock moves, but you also have to be right about the timing. So that really ratchets up the degree of difficulty. To make a profit, the stock doesn't just need to go past the strike price, but it also must do so within a defined period of time. So in the case of these $80 calls on Facebook, you need the stock to reach $80 within 30 days to make a profit. So you're asking that stock to move more than 23% in less than a month. And in options speak, this would be over a 2 standard deviation move. So how many stocks are likely to do that? Well, there are some that do that, and we see it all the time. But the real answer is there are not that many. In all probability, the stock would not reach that strike price, and the options would expire worthless. So based on probabilities, and trading is just about probabilities. You want to try to find things that are high probability, in my opinion. So based on probabilities and using standard deviation to measure it, there's only about a 5% chance of this stock reaching $80 by expiration. So in order to make money on an out-of-the-money call, you either need to outwit the market or get plain lucky, or you're inside trading and you're going to go to jail. So again, being close means no cigar. So imagine though the stock did rise to $70 within 30 days of your option lifetime. Well, you could say, well, I was right on direction of the stock, but since you're wrong about how far it went within that specific time frame, you still lost your total investment. So based on this newbie option trader mistake, a better goal for every trader, in my opinion, would be to select trades based on what provides the most consistent positive returns. And one of the best ways to achieve this is by using option strategies that take advantage of selling options for income generation. So then the next question is, well, how is this done and what is involved? Well, the most important option factor for income generation comes down to time, and what we call in option terms time value. Time value is used for trading strategies that take advantage of the accelerated time decay of an option into its expiration. And then option income strategies, they're very, very tied to the time value and the impact it has on the price of an option. So time value also is referred to as extrinsic value of the option, and it's the premium a rational investor would pay over its current exercise value, which is the intrinsic value, based on its potential to increase in value before expiring. Now, this probability is always greater than 0. Thus, an option is always going to be worth more than its current exercise value because of that extrinsic value. Now, time decay exponentially goes to 0 at expiration, and the general rule will be that an option will lose about 1/3 of its value during the first half of its life and 2/3 in that second half. So it really accelerates. So as the option moves closer to expiration, moving its price requires an increasingly large move in the price of the underlying security. So, if you're trading against the current, or if you're going against the current, it just makes everything a lot more difficult. So you can start utilizing the effects of time decay and use that in your favor. Then, you're kind of going with the current and you're going with the trend. So it's very important to take that into consideration on a lot of your different trade setups if you're using options. So here's your typical time graph, and let me pull up a pen here. So this is the time decay. You know, as you go farther out, so 120 to 90 days, it's a very, very slow time decay. And in options, we call that theta decay. And you can measure this. The other really cool thing about options and most option platforms is that you have all these free tools that you can utilize. And one of them is the theta decay, and you can see exactly what it'll be at any point in time. So as you get, you know, closer and closer to that expiration, you can see how it steepens and falls off and then goes, you know, to zero. So if you can use this and trade in the direction and have this as a trend rather than swimming against the current, it surely helps your trading. You can do some really cool things. So step 4 is then, okay, well, how does option pricing work? Well, this is the value of an option. It's basically the time value times its implied volatility times that intrinsic extrinsic value. So once you know these variables, then you're ready to price an option and know what its option premium should be. So, you know, let's just kind of review the implied volatility, what that is. It's what the marketplace is implying the volatility of the stock will be in the future based on its current price. So that's another thing you can take advantage of, is implied volatility, because if implied volatility is created by its current price, what happens, you know, the next day? So, like for example, if you know you have a really hard down day, that increases the implied volatility, which increases the premium. So then, you know, as premiums get spiked higher, you can take advantage of that. The next day, you know, the market may just settle down. So by selling high price premium, you can take advantage of that increase in implied volatility and use it to your advantage. So that's another thing. And then there's the intrinsic value. Again, that's the amount an option is in the money. And there's that extrinsic value. That's the price of an option less that intrinsic value. So it's the out of the money portion. So these are the concepts that you just have to understand. And then you can price an option. And basically it's just, again, it's just this time value of the option times the implied volatility that it has times that intrinsic extrinsic, and that gives you your option premium. So here in this table, this is based on a weekly option. When you come in on a Thursday, you get a new option series, and it's got 100% time in it. So if I kept this intrinsic extrinsic constant just so you can see the values, how they work. So if the implied volatility is real high, say it's at 300%, or you put in 300, then that gives you a premium of $300. Now you can see the next day it goes down by 1/8. So even when you have that implied volatility still at 300 and you have this constant, you can see that your premium's going down. So, you know, you can take advantage of that, or you can, you know, trade it, but you need a really high, hard move to the upside to compensate for that time decay. And then you can see here Monday, you know, you're about halfway through it. So when you've got a spike on implied volatility up to 800, you still barely moved the actual premium. So, you know, these are the concepts that you need to understand, and once you get that down, it's not that complicated, then you can start doing some really neat things. And the other thing that I love about options and some of the specific strategies is that you can do these type trades with a very small account, and it helps you take a small account and start building it into a bigger account, also by defining your risk and keeping a really kind of more smooth, constant equity curve. So then step 5 is selecting the right income option strategy. So the goal of every trader, in my opinion, should be to select trades based on what provides the most consistent positive return, not all the time maybe the biggest return. And one of the best ways to achieve this is by knowing the income option strategies that are available and then selecting the one that is best for your trading style and trading plan. Now everybody, you know, here today, we're all different. So we're all going to have different styles that we do of trading. We're all going to have different lifestyles. So, you know, you might not be able to be at a desk all day trading. You might not want to be at a desk all day trading. You might want to be, you know, just maybe trade an hour a day or a half an hour, or maybe look at things at night and then set up something in the morning, go out to the golf course, go work on something else. So everybody has a different style. And with options, you can plan your trading plan around your style and then develop the type of trades that you want to take advantage of. So what I put together here are income strategies, and I've laid out 5 different strategies, and we'll just go through each one of them so you can kind of get a feel for maybe which one fits your type of style, your type of lifestyle better than the others. So the first strategy is the covered calls and puts, and this is something that one of the more common ones that you may have used a lot, you may have seen, but it's one of the most common ones out there. So for monthly income, writing stock options is the basic component of the strategy. When writing stock options, the premium from the sale is deposited straight account the next business day. So you get to keep that premium regardless of what the stock does. So that's the cool thing about it, man. It's just you're putting money straight into your bank account. So the cash from writing the stock options can compound into really great wealth. And for those of you that understand that compounding, know that if you could take say a 5% gain every month and compound that, that can really make you rich and really build some really great wealth through the power of compounding. Now, most investors, though, overlook the wealth-building power of compounding and simply purchase stocks with the hopes it's going to increase in value. You're sit there and you're waiting for it to go up, thinking that eventually it has to go up, right? So a lot of times, though, we're disappointed it doesn't. So if you're doing the other side of this thing as a stock option writer, you're able to increase your return significantly, while that traditional investor still just waits and hopes for that big upward stock movement. So, we've all probably been there. I can remember specifically, when I was running the trading desk and stuff, I had a lot of capital that I put with some fund managers because I didn't have the time really to take care of my own money, which is pretty bad. So, I left it to them. And what did they do? The traditional investing. Buy, hold, and then you can think about what happens when you have periods like 2000, 2007, 2008. So it's not pretty, and we've all been there, and that's something that probably all of us are here for, is to be in more control of our own money. So again, getting back to compounding, if you are doing covered calls in a self-directed IRA and you could get 5% a month, you can literally take $978 and you can grow that to over 340 or 340 in 10 years if you compound it. That's just the way the math works out. In contrast, if you put your money in the bank today and you're lucky to get 2% interest, it'd take you 100 years to get up to 300. So, these are important things to understand and try to, incorporate with your own money if you can. So stock covered call options in an IRA can really provide you a way to make up for those years when your retirement fund didn't grow fast enough or not at all, or when you're even losing money. So then there's the covered call versus covered puts. And if the market is strong, then you want to write covered call options. You want to treat that stock as commodity traded to generate that monthly income, just as you do rental properties. It's not important to want to own the stock the options are written against. It's actually to your advantage if the stock is called away. Then you get to keep that premium. It's important that you like the stock's short-term potential, and by knowing the potential for the short-term to go up, then that's what you're looking for when you're writing options against a stock. But writing stock covered call options, it's a great source of income when the market's going up, but what about those times when the market is falling off the cliff like we've been seeing the last couple of weeks? Then what do? Well, if the market is weak, there are a couple of things that you can do. You can either go to cash and sit, but if you're looking for income, you can't sit too long. Or the other thing you can do, if the market's going down, you can sell covered puts. And now this is writing a stock covered put option. This allows you to profit from a declining stock market. With the stock covered put option, you have already sold the stock short, so you don't really care if it drops. Actually, if you're short the stock, you want it to drop. And then the other thing is you've sold puts against it, so you're collecting income on that short position. So the other option income strategy to use, though, in a weak market, and this is the one I like to use, is to write covered call options on inverse funds or bear market ETFs. So here's just a list. There's a bunch of them out there, some really good inverse ETFs. And the ones that I usually use, I'll use the ultra short S&P 500, which is the SDS right there in the middle. This is a really good one. Tight bid offer spread. That's a really excellent one. The ultra QQQ short QID is a good one, and then the Russell TWM. So these are all really nice, inverse ETFs that you can use, and then you just basically buy that inverse, and then you sell call options against that. So that's the way to do it, and it works really well in a down market. So strategy 2 is what we call a calendar spread. And the calendar spread is a neutral option strategy that profits when the underlying stock remains stagnant or trades within a tight price range. A calendar spread profits primarily from the difference in the rate of premium decay between that near short-term option you're short and that long-term option or leap that you're long. And this is possible as that, remember from the earlier slides, that near-term option premium decays fast. So this is a strategy where you can take advantage of that really fast accelerated time decay while you own the long option premium, which has very small time decay or theta decay. So here's what it looks like when you look at a time chart. So what you're going to do here, for example, is let's say you want to be short, the short-term option, and then long something further back. So you do this usually at the same strike price. So let's say you're long the $30 calls on Microsoft or something. So you're going to be long that 60 days out. So that option 6 series. So you're long that one, and then you're going to be short the $30 strike 30 days, or you can even use weekly options, 15 days or 7. And then what happens here is you're taking advantage of this steep time decay or theta decay. So you're short this spread, you're short this option, it goes to 0, you collect and keep all that premium, and this option that you're long back here is barely decaying in time. And this is also a good strategy for kind of warehousing. If you think a stock might eventually, it's maybe at a bottom or something, but you think it's going to go up, this is a really good option strategy to take advantage of it while you're waiting and collect a little option income or premium on it. So it's a cool strategy to utilize in certain situations. So that's the calendar spread. Now, the third strategy is the diagonal spread. And I like this one a lot too. And in this version, this is a version of the calendar spread. And all you have to do is you purchase an in-the-money leap is the way I usually do it, which is a long-term option that might be out a year or even more, and then you sell an at-the-money or out-of-the-money near-term call against it. And this was an example of a trade earlier in the year, back in January. This was on USO, and this was utilizing this diagonal calendar spread. So in this particular trade, USO, the ETF for oil, was trading at $35. And so instead of buying the underlying USO at 35, you bought the 10 contracts of the USO Jan 2015, way out there, $25 call options. They were going around $10 per option, and then sold 10 contracts of the USO at that time, April 2014, $35 calls, and collected 60 cents or $60 a contract. So here's the way it looks, based on the math. So the credit received from selling the 35 call was $60 per option contract. The cost was the January 2015 25 calls. They were going around $10 or $1,000 per option contract. Remember, one option contract is 100 shares. So your debit here was $1,000. The credit you received in was $60. So your defined capital at risk was $940 per contract. Now, the April 35 calls right here, if they close below $35, you keep that whole $60 credit. So then your return here is the $60 return over the cost, your capital at risk. That's a 6% return. On an annualized basis, it's around 72%. So that's if you did the diagonal spread, which is I also call like a covered leap. So instead of a covered call, I'll just use the term covered leap. And then the other side of it, well, you could have done the old standard way of buying the USO ETF, and still you had sold the 35 calls, you collect the $60, but instead of buying the leap, you bought the ETF. You bought it, and it was going at $35. You'd buy 100 shares to make it equivalent, so that cost you $3,500. So your debit there's $3,500, and if it closed below 35 by April, the end of the expiration, you still collect and keep that $60, but your return goes down to 1.7% because your capital at risk is much greater, so your return is much lower. So this is the two different ways. Now this strategy you want to use when you think the market on a bottom type market. You don't want to use it when the market's already up here maybe and is consolidating sideways, because if it goes down, then that really damages it. But it's a really good strategy for bottoms in markets. So if you see a certain ETF sector, a commodity or whatever that looks like it's really looking to move back up, but it could be a long-term type of trade setup, this is a good strategy to incorporate. So strategy 4 is the credit spreads, and these are my favorite, the credit spreads. And basically these are short vertical spreads, or called credit spreads. And they're basically three basic types. There's the bear call credit spread, there's the bull put credit spread, and then there's the long iron condor. Now the construction is the bear call credit spread is you're just basically long one call while simultaneously short a call with a lower strike in the same month. So this is a bearish strategy, and you're selling, collecting premium, and then you've got an insurance against it. So then you've got the bull put credit spread. This is basically your short one put while simultaneously long a put with a lower strike in the same month. So that's your insurance policy. So it's a low-cost stock directional type play. When constructed properly, this spread is an excellent premium collection strategy. So then if you put the two together, that creates what we call a long condor. So it is the combination of that bull put credit spread and the bear call credit spread. And there should be equal distance between each strike price, while underlying stock or the penny strike should be between the two credit spreads. So basically, if you're not familiar with it, this is what it looks like. You're going to be, the bear call credit spread is you're going to be short, let's say the $100 call, and for that you collect, let's say, $100, and then above it you're going to be long. We'll say it's a $5 wide spread. The $105 call, that's your insurance policy. So this is a $5 wide spread. So basically $5, 500 less your premium you collected makes your total capital at risk is 400, but your premium collected is 100. So you're looking for in this particular type of setup, you want this particular trade to close below $100. If it closed below, you keep that whole 100. Now the other side of that is the bull put credit spread. So here maybe you're short the $80 put, and as your insurance premium, you buy the $75 put below it. Here you've got that $500 wide spread, and let's say again here you collected $100 for selling that put, and the spread is 500. So again, you've got at risk 400. But if this closes above 80, you keep that $100. So you could, with the iron condor, end up making on this $200 if it closes between. So these are really cool spreads to do for various situations. This particular one in a non-directional type sideways market, and the other ones, you can imagine on selling a bear call credit spread. You want the market to be, trading lower or trending lower, and the bull put credit spread is to take advantage of the trending market to the upside. So I like these, especially when you have markets where the implied volatility is moved up like we have right now. So in options, I'm going to go through this. This is basically what it's all built on. So the short vertical spreads or credit spreads, when used correctly, will provide the trader or investor the greatest probability of success and are one of the best ways to generate a steady stream of income, and it's all based upon the math of probabilities. So market makers, this is going to show you a little example about the way it works. Market makers will use what we call an implied volatility of an option to set an option's price and to forecast the expected implied move of a stock either up or down by the expiration of a specific option series. Now this is also referred to as a one standard deviation move and is based on the statistics of a normal distribution curve, which is this. If you ever took statistics, this is kind of the probability curve. And this, basically what you're doing here is, in this example, let's say you had a stock that's trading at $500 right here. Now the market makers will give you on any option series the implied move, and you can get this, or different ways you can do it, but in this example it's plus or minus, say, 4%. So what they're saying is that by expiration, this stock, we'll call it Google, the probability is that it could go up 4% or down 4% by option expiration. So if you did that, it could go down to $480, or it could go up to $520 by expiration. And we could say expirations in 7 days or whatever. So between now and 7 days, a one standard deviation move would be either between 480 or 520. And that gives you a 68.2% of the time, based on what the option makers are telling you, Google would close between 480 to 520 in 7 days. So by knowing these statistics, you might not want to buy puts that are, below 480 or calls that are above 520, because then your percent chance of winning goes way down. So let's say if you bought something that was below 480, then you've got a 15.9% less chance of that being at below 480 at the option expiration. So when you understand the implied moves and how you can set targets, this is a really great thing to put options to your advantage. So based on the math of probabilities, you can see why in this little example 70% of options expire worthless, and why it's also a good idea to consider selling options as well as buying. So if you were buying the 480, your chance of making money on that is very low, versus if you're selling puts at 480 or selling calls at 520, you've got a higher percentage chance that those will expire worthless. So that is kind of what it looks like when you map it out. Now here's a good example to show you this. This is Wynn Resorts, and this is going to compare two bullish option strategies. One is buying directional calls, the old standard way to do it, and the second strategy is selling a bull put credit spread. So this was like back on May 1st, and Wynn was trading at $207. So strategy one, you bought the at the money 207 calls on Wynn, and they were going at $11.40 or $1,140 per option contract. Strategy two, though, would be the other way to do it. It's also a bull strategy. It's selling the out of the money bull put credit spread, which was below Wynn's prior low of $189, and that was also at a 9.5% below its trading price of $207. So it's a big advantage here on strategy two, because it's got a lot more cushion and room for mistake or error if the Wynn should trade off. So strategy one right here is a debit and capital at risk is your $1,140, but your return is infinite. So here's your profit infinite return to the upside. Max loss, though, would be 1,140. So that's strategy one. And this is what it looks like. So if on, and this is, what happened, here's the June 207 call, and here's your May 8th. You can see this is May 1st when the trade was entered. The market was trading at $207. And then on May 8th, though, WIN got hit real hard and sold off and was trading at $196. Now, when that price fell down to 196, the options that were the 207 strike calls, which you paid 1,140 for, those now were trading at $583. They went down, and you had a loss based on this May 8th of $583 per option contract based on that fall off. So that's the hazard when you're just long directional calls. If the market does go against you, you can start getting hurt real fast. So that's May 8th. Now on May 21st, just to kind of keep this example progression of this trade moving, May 21st, WIN had come back up to $205. So right here is May 21st, and it's only $2, below the 207 call, but you're still down on this trade $518 per option contract. Now contrast that to if you'd sold in a bull put credit spread, and here's what that would look like. You collected $130, your max profit's $130 right here. It's a $500 wide spread, so your max loss is defined, locked in at $370, worst case. So your potential profit here, if it closes, you're selling the strike down here, you're selling right down here. You can see the 187 puts, which are way below where WIN was trading on the first, which was 207. So you're about 9.5% below down here. So WIN would have to fall over 9.5% and have to fall also below your insurance premium, your 182 that you bought, to lose money on this trade. But also the max you'd lose is 370 versus the other trade, which you could lose over $1,000. So here's what this particular strategy looks like when the market goes down. So on May 8th, WIN was trading again at 196, but this credit spread was only down $38.50 versus if you were long the call was down $583. So huge difference there. And then on May 21st, right here, WIN was trading at 205. The credit spread was now profitable, $78.50, versus those long calls still being down $518. So big difference in the two strategies. I mean, one is for hitting the home run, and the second one is for more consistent positive equity curve. So this is one more strategy, or one more trade example, and this is on Tesla, and this is using a credit spread again, and this is in the money, kind of a deep in the money bull put credit spread, and also bullish option strategy. So this was Tesla this past week, and this was based on Tesla breaking out to the upside. So the trade was put on on Friday, the last Friday, the 1st of August. This is what I call a volatility squeeze, and it was a play to take advantage of a break to the upside. So instead of risking a lot of capital, this was a really cool little trade setup where it risked a very limited amount of capital. So here's what the trade looked like. So this was an in-the-money bull put credit spread. So this was entered on the 1st of August. Tesla was trading at 232, and the exit was based on option expiration on this past Friday, and Tesla closed at 248.13. So on this, the weekly options were used, 7 days to expiration. The implied move, the market makers were telling you, is a 0.4 8% up or down. So your target high based on that could be 243, target low 221. Now the credit spread was selling down here. You can see at the bottom was selling a 245 put and buying the 242.5 put. So it's a $250 wide spread. So that particular trade was 13. I mean, it's a little bit, maybe a little bit confusing for you if you've never done these, but I wanted to show you the risk reward on this. So this credit spread on this particular setup, selling in the money put spread, the premium collected was $197, and your max loss based on this spread was only $53. So a fantastic risk reward on this. So your maximum capital at risk was that $53, and if this closed above, let's see, this was selling the put spread, so if it closed above 245, you're going to keep the full premium of 197, and that is a return of 197, you know, and your capital at risk 53, that's over 300% return. And the really thing that is beautiful about this is that your capital at risk is only $53. So, you know, even if you had a small account, this is the type trade setups you can do. You know what your maximum risk exposure is, but it still has a really great potential return to the upside if you structure the trade properly. So that's the thing that you can do with these type of option strategies that collect premium, and especially the credit spreads. So, you know, what I wanted to go over here today, you know, was just to kind of give you the 5-step plan for option income success, just to kind of explore what you can do with options, the other way to look at using options. So, you know, how to embrace that risk for trading opportunities, avoiding the #1 option trading mistake that, you know, always constantly thinking you have to buy options, the most important option factors, you know, how to look at pricing an option, and then, you know, went over the various income strategies to kind of give you an idea of what you can use and perhaps which strategy might best fit your, you know, style of trading. So, you know, I hope this was helpful to you. Now, you know, seen a lot of questions here, so I'm going to try to get to as many of these as I can before this my time is over. But you know, I'll answer all your questions in a few minutes, but also we'll also tell you a little bit more about how you can learn a lot more about trading credit spreads. But one thing I hope you understand that, you know, within an hour there's only so much information I can go over and so much I can teach you without, you know, just totally hosing you guys with way too much information. So that being said, I'd like to also say thanks for giving me this chance today to share some of my trading experience and knowledge with you all, and hopefully what I was able to share with you will, you know, help you make a difference in your trading in the short term, maybe money, also give you some ideas of maybe some other things you should start looking at. Now, I realize also that a lot of you don't know me at all, so I'd like to share, you know, one email I received not long ago from one of my clients, Charles, and it's always such a great honor to find out that, you know, you are making a difference in someone's trading. So if you have a minute or so, you know, take a look at this email that I received from Charles. Now, one thing in this this email, you'll notice that he said before he took my option income course, he didn't know all the creative ways to defend a credit spread. And I loved how he referred to the Swiss Army knife because, you know, to me it's kind of one of those international symbols of the one tool everyone needs in their pocket or in their toolbox. So, you know, to know that I'm making a difference is really a great feeling and very rewarding for me. So this just kind of gives you a little bit of idea of, you know, satisfied clients that I had. So next, let's talk about, before I end here today and get in your questions, some simple things you can start doing now to generate a more steady stream of income each and every month, and also how you can learn to implement an option income stream. So, again, I want to just emphasize that the real aha trading moment for me was when I started to incorporate credit spreads into my trading. So it really can't, I really can't express enough the importance of using them in your trading. If you're not already using them, try to incorporate some within what you're currently doing, and it will definitely smooth out your trading results and give you some other different ways to take advantage of the markets. Now, I recently had a credit spread course that I did, and I've got this as it's a recorded workshop, and it's a 4-hour recorded step-by-step workshop. This was a live boot camp I did on just credit spreads, and it's recorded. It was supposed to be about 2 hours. It ended up 4 hours, so it's a lot of great course material. And you'll also get, with this 4-hour recorded, all these modules, you'll get an 89-page PowerPoint of this course. So it's all recorded, so it's right there. You can get it online immediately. And let me put the link into you. It's powercycletrading.com/spread, and it's $97. Now, the good thing too is that if if it doesn't work for you, I'll be happy to refund your money. So just put that link in, powercycletrading.com/spread, and you're going to get a full course on how to incorporate credit spreads and use these to your advantage. And it's a $97 course. Now, the bonus, though, I'm going to give for the first 50 that purchase this credit spread course today on income course, you're going to also receive free access to my live. It's going to be a new live credit spread course that I'll be doing on Saturday, August the 23rd. So this is going to be another workshop strictly on credit spreads. We're going to go over a lot of different things that I've incorporating now. A lot more of the in-the-money type credit spreads that I showed you in that last example, how to set those trades up, how to look for those trades and take those to your advantage. So if you sign up here today with this current credit spread course, you're going to get access to the new course that will be the 23rd of August. And yeah, here's that link again. And then the other thing I always like to do is do a follow-up accountability and support Q&A. So, all the time, if you take whatever course that you take, whenever I take a course, after I go through the course, I always have a ton of questions. So what we're going to do is, about a week or 2 weeks later, we'll have a follow-up Q&A where we'll go and take all your questions regarding any of the information in the course or anything that you want to discuss. So this is going to be limited to the first 50 here today, because I want to keep these groups small, so it's I have a chance to answer all the questions. So I hope you'll join me. It's $97. 30 years of trading experience. You're going to get a lot of information out of this. And here's just some of what's covered in this current course. It's how to use credit spreads to create low-risk, high-probability trades, how to use credit spreads on stocks and index options, such as the SPX or NDX, how to use non-directional credit spreads and when to use those, how to steadily and consistently grow a small account. This is a big part of it, through credit spreads into a big, large account. And then how to defend. I've go over 6 different defensive strategies that you can incorporate, which is a big part of it. And then how and when to use iron condors. It's just certain situations for iron condors. You're not going to always want to use them. So again, this is another really neat part, is how to take a 70% probability and turn it into 90%. And then a step-by-step guide of how to execute these spreads. And then we'll also go through the technical analysis, some of the best technical analysis ways to look at the markets for your trade setup. So it's a ton of great information, and it's going to teach you a lot. And if it doesn't work for you, then you just let me know, and I'll be happy to refund your money. So just put in powercycletrading.com/spread, and the first 50 here that sign up are also going to get invited to that free live workshop that I'm doing on the 23rd. So put that out there for you. Now let's see questions. Yeah, the in-the-money credit spreads. You can do, question, are the in-the-money credit spreads for weekly options or monthly? You can do either one. It really depends on the trade setup, but either one. I usually will do those with weekly options to take advantage of that time decay. Do you ever have a direction long call and turn it into a spread? Absolutely. One of the ways I like to do directional plays is I first like to start out, if I'm going to do directional buying options, I like to start out first by just buying the options, getting the direction right, and then if it goes in my direction, which hopefully it is, then after it moves higher, I'll usually a lot of times sell an option against it to lock in some premium and to hedge myself, and then also to take advantage of that theta decay. So I'll do that quite a bit. Yeah, okay, hold on, Charles. I'll put the URL in there again. And again, the thing about this course is you're going to get the current course that I have, and then you can go through that, and then we're going to do another live one for the first 50 here today, and that will be on August 23rd, and it's going to be a live course. I always have additional new things that I bring into a course. So this will be in there. Plus, you're already going to understand a lot of this because you have the course ahead of time from my prior course. And so the other thing too is getting the PowerPoints will be very, very beneficial to you, and then that follow-up Q&A. So it's a great way to learn, and the price of entry is so low that even if it doesn't work for you, it doesn't cost you a whole lot. And this is stuff you can get, come back to whenever you want. It's all there, all the digital recordings and everything. Let's see here. There are a lot of questions. I wish I had more time. So yeah, defending the credit spreads in this course, I've got 6 different strategies for defense, which is a really plus. If you understand some of the defensive strategies to use, incorporate that alone, when you go into trade, knowing what your potential defenses are really helps, develop your confidence as a trader. And, confidence spells and profits in trading. So just by getting some of these defensive measures will definitely help your trading. I've only traded options for 1 month and made $17,000 the first 3 weeks. Fantastic, but lost $7,000 the past week. I cannot fix trades that go wrong in my IRA. Rolling spreads, is there any way to get around that type of restriction? Well, if you, in your IRA, if you can structure, kind of have more balanced portfolio where you're, incorporating some credit spreads or some type of credit type option strategies along with your directionals, it's going to smooth out your portfolio in general. So if you can, look at the markets and you have a way to see what the market direction is, then you can start also doing other types of strategies. So, these are part of the trading that the hard part of the trading is the direction of the market and adapting what you're doing for the various situations. But that's why a lot of times you should have a more kind of balanced portfolio of what you're doing, not just being long direction, period, having some other type of strategies that are more spread oriented where you can take advantage of defining your risk a little bit better and reducing the potential downside risk. And that's what credit spreads can really do. You can see in that one example where your risk was only about $50 and your upside was 3 to 1. So those kind of things can really make a big difference. If it's not taking your order, then send me an email, Larry at Power Cycle Trading, and we'll make sure that that order goes through, Larry. So here, let me give you that email address. And I'll make sure that you get there. Just put in your email address there, and I'll guarantee that you're one of the first 50. So if you have a trouble with the order, sometimes it's the browser you use. So I've been using Internet Explorer. It works just fine. No, on this course you're going to get the current credit spread course, which is recorded, along with its 89-page PowerPoint. And then for the first 50 that are in today, you're going to get my new webinar that I'm going to be doing. It's a workshop on August the 23rd, and it will be live, and it'll also be just strictly on credit spreads, 100%. And then with that course, you'll also get the recording of that course, plus the PowerPoints and any other handouts. So you're going to get everything, and then also the follow-up Q&A. So you're basically getting 2 courses out of this, plus a follow-up Q&A, all for $97. So pretty good deal. But it's a great place to learn this kind of stuff, and I go into a great amount of detail. I mean, just today, within an hour, there's just so little time to spend on it. There's just a lot to cover. But you'll walk away a lot more confident and understanding what they are. Okay, great, Jim. Look forward to working with you. When will option trading be talked about? What time? I usually start these live events at about 10 o'clock Central. So 10 o'clock Central on a Saturday. Come in, get your coffee, and then it'll go usually 3, maybe 4 hours. Usually I shoot for 3, but they tend to always go over. And if you can't stay, it's recorded, so you can always get the information, later at your leisure. Let's see. Here's my email address. Oh, yeah, there it is. And then, yeah, here, let me give you that course URL again. A lot of folks asking for that another time. There you go. So take advantage of this, the opportunity to get in there and learn from somebody that's been doing this a long time. It should help you a lot. And by incorporating income option type strategies, especially the credit spreads, what I like to do is I do a basket. So I'll do if a trade looks really good to the upside or downside, and I like the trade based on the setup, instead of just doing everything long directional options, I'll do a combination basket where I'll buy some directional options, and then I'll diversify it, and then I'll do some credit spreads with it. And instead of putting $1,000 on one particular strategy, I'll incorporate several different option strategies to diversify that risk. So we'll talk about that and show you how that's done. So just be a lot of great stuff that you probably haven't seen before, and if you have, it's also going to just everybody always has a little different twist of ways to do things, so probably definitely help what you're currently doing. And it's an easy, low entry price to get into to take advantage of all the stuff that I'll be passing on to you. The recordings are all digital, so you shouldn't need trouble. You can access these at any time. All right, and I guess my time is over. I appreciate very much everybody being here, and thank you, Jeanette and Hubert, for having me here today.
Thank you, Larry. Thank you very much. All right, guys, so Larry's special offer is powercycletrading.com/spread. I'm going to put it in the chat box and send it to you, so if you want to click the link, you can do so. So take advantage of Larry's special offer. Also, if you do end up taking his course, which you should, ask him a question about some of his stories in the crude oil market. They're very fascinating, and you'll learn lots of cool information about crude oil. All right, so we're going to take a quick 5-minute break.